you have to be able to pitch, right? And you have to know what you're selling. This is a sales business. This is an investment management business and a trust relationship business. It is not a manifesto business. We're focused on returns and taking that inefficiency that we were seeing between capital allocation. And it took a few refinements. It was like kind of tumbling, polishing a rock to get it to that place. That was a learning process. And every manager is going to have to go through that as they're practicing. And truly, I don't believe it matters whether you're a first-time fund manager.
You will fail as an investor if you're still picking founders the old school way. In this conversation, we reveal the real traits top VCs look for and how missing them could cost you billions. So if you want to outsmart the market and dominate the next decade, this episode's for you. All this and more coming right now. Here we go. Joe, welcome to the show, man.
Ryan, thank you for having me. I'm a huge fan of you and the Making Billions community, and I'm just stoked to be here and looking forward to having a really, really fun and engaging conversation with you.
Hey, stoked to have you, man. So let's dive in, brother. When you're talking to add Daring Ventures, what's the core filter that you guys use to decide very quickly whether a founder is even worth serious consideration?
Yeah, what we look for is, what's the founder's unique edge in what they're building? Industry experience for us is absolutely paramount. We ultimately want to know, what does this founder know about the rest of about their market that the rest of the world just doesn't understand, and it's that specific knowledge that we think is going to make their approach super sticky. They're going to be really, really compelling to customers. They're going to get out there way faster than everybody else.
Brilliant. So how does that help you when now that you're looking at founders? What does that do as far as creating a short list, or how much weight do you put on what you discover from this?
Yeah, we weight the founders, founder market fit and that unfair advantage extremely heavily. We think that is the number one decider of success, especially at the pre-seed stage. When everybody can build something, having that speed to conviction and knowing what to build faster than everybody else, that just gives you the edge that used to be dominated by technical know-how. Technical know-how is obviously very important, and that's something that we slot in. We want to see well-rounded and strong teams, but we do want to see that the focus on the founder who's got just an undeniable right to win in their space. It's almost always defined by a long career, long exposure, some inherited knowledge of being in or around that space, of growing up in that space in a way that nobody else really can.
Yeah, it almost helps you to weed out the tourists from the titans, doesn't it?
Yeah, that's absolutely right. We are looking for generational founders who are, building the next era of just massive companies. And being a founder is extremely hard. It's a very, very long and lonely road. And it's not a great place for for tourists and people who back down at the first sight of difficulty. Yeah,
I was talking to he's a founder legend. He's also a partner of mine at Darkside, but Travis Steffen's his name, and we had a good chat. We're saying it seems like AI is teaching people not to work, like you almost outsource your thinking. And we were kind of belly aching of how hard it is. This thing that we're talking about right now is just finding good founders who they have the gusto and the chops to push through the challenging things that they will face. And obviously we're there to help them out, but you're spot on, man. Like finding the right people and separating those titans from tourists and picking those, that's the challenge. And it sounds like you've got quite a good system. So, once they pass that initial filter, what is your step-by-step process for evaluating whether they're actually truly exceptional?
Yeah, once they pass through the filter, we get aligned on myself and my business partner, Maddie Coleman, the other GP of the fund. Once we're aligned on the founder, then it is on to typical technical diligence, product and market diligence, and a normal due diligence process that you'd expect for an early stage startup. We want to see, of course, that they have that alignment, but we also need to see that they have, that there's something real there. So we're always looking for a product that is already built. Pre-revenue is okay, but we don't invest at pre-product. We're looking to see, do they have the right distribution channels, right? Do they have a strong partnership? That can sometimes supplant, early revenue. If this is a business that's operating in an industry where there are really long sales cycles, we will accept and we're understanding of the nuances and dynamics of different businesses, because we tend to play in things that are people, process, or paper heavy, regulated, complex, very labor intensive, and these are not always the easiest businesses or the easiest industries to sell into. This isn't consumer tech, right? So we're always looking for proof, traction, stickiness, and that ability to go to market faster than everybody else.
Brilliant. And so, and you're right. I mean, there's no point going too far down the due diligence route until you have at least some of these that fit sounds like your buy box. I love that. And so during that process, what signals do you intentionally overweight and which common signals do you just completely ignore?
The big one for us is, what is the founder's relationship with adversity, right? Do they have the grit? Do they have the tenacity? Are they able to learn and think on their feet? We're looking for what has this founder gone through in their life, personally, professionally, that gives them that resilience. There's a lot of people out there who've never heard no before in their life, and the market will not hesitate to tell you no. Customers are ruthless with their dollars. They want a product, they want a service that is worth it for them, where they'll just walk away. They don't care where you went to school. They don't care who your mom or dad is. They are, they're ruthless. They're vicious and they're honest. And we're looking for founders who can, who can withstand that. We underweight, prestige and technical ability, especially at the earliest stage. We don't invest in hardware. We're backing founders who are, do the B2B software. They're not in the atoms business. They're not in the cells business. They're not doing stuff off planet, right? Those are places where deep technical expertise can be really, really advantageous. We don't see that as something that's necessary for us. So of course, we're not against it. And it is important to have a team with technical capability. We're shipping software at the end of the day. But the number one thing that we're looking for is that tenacity. And what that really means for the investors who back us is that we are putting our dollars behind founders who are now never going to quit. When you invest in a VC fund, this is a long-term relationship, and it's our responsibility to our LPs and also to our founders to be in it for the long haul. We uphold that end of the partnership, and we expect our founders to be there too, because the going will get tough. It will absolutely get tough, and we all need to be in it together.
Yeah, brilliant. So how do those founder insights translate into a broader investment thesis at Daring Ventures?
Yeah, founders have always been the most important thing in venture capital. They've been the lifeblood of VC. And what skills, what talent, what knowledge that founder brings to the table has always been really important. And in the past, that was very, very aggressively weighted towards technical skills, right? 30 years ago, people didn't build software for people. Companies, were stood up to build software for other companies. Down the line, then it's, you need to hire a dev team, and somebody needs to go down to Fry's and pick up the servers and wire them up. And even as recently as 10 years ago, why would you bother building it when you can rent it? But the barrier to building has been so it's basically shattered, right? Anybody can code. That is eliminated, and the grit and the resilience and the resourcefulness of founders is taking a front seat. AI has allowed people with great ideas who don't have coding skills to prove out that market, rather than fighting over telling engineers, I promise you this is going to be good. They build it, they prove that traction, and they can hire great engineers. I think there's a really key insight here, which is that the founder profile has shifted, and investors, this is such an exciting time to be an investor. And investors should remember that the aperture has just opened. It is expanded in a way that has never, it hasn't expanded in a long time. But there are people out there who are having their Web 1.0 moment right now. Downloading Claude Code, pushing code for the first time, signing up for a GitHub account, solving problems that they've always been thinking, oh man, somebody should build something. And then they're looking in the mirror and thinking, wait, I might be somebody. That may be me. And they're taking that plunge. And we're so excited to see these, this new generation of founders that are going crazy at building.
It's almost the march of the vibe coders. I love it. And like you said, with AI and vibe coding now, I mean, it's a maturing market, but I think that skill, like you said, it used to be top priority. All of that, people who know how to link up servers and all of the coding and all that stuff. And you're like, it's not really that much of a rare skill anymore because AI does a lot of the heavy lifting. I'm being very general, but now I think what we're saying here is the qualities, the intangible qualities of a founder, not just the ability to build and code, but it's actually with grit and tenacity. Is that kind of what you're seeing out there right now?
Yeah, absolutely. I mean, there's an infinite amount of knowledge now and an infinite amount of synthesis and analysis of that knowledge. Scarcity is a great editor, and knowing what to do can make you a 10x developer, a 10x engineer.
Yeah, I love it. So then with that, how do you design your deal sourcing strategy so it consistently surfaces founders who fit into that thesis, those type that you're talking about?
Starts with getting out of the office. Both myself and Maddie, we have over the last year embedded ourselves in the New York VC ecosystem. We are each out 2, 3, 4 nights a week, meeting with founders and going to events and representing not just our firm, but our portfolio and our thesis. Getting out there and listening to founders and pounding the pavement and spreading our thesis and our viewpoint far and wide. And we've been really, really fortunate to have built some really strong relationships. We get out of New York when we can. We build it public. We're loud. We won't hesitate to tell the world that we're out there and that we're investing at the pre-seed stage, and it's served us really well. We've seen over 1,000 inbound deals over the last year. We're really fortunate to have such a great resonance with the founder community.
Brilliant. So, with that, so we talked about founders and finding them and deal flow, and all that comes into managing a fund effectively. And, given the limited time and even imperfect information that you and a lot of VCs face, how do you structure that diligence to move fast without missing fatal flaws?
Yeah, we leverage networks. And I think every VC says that, but we see this as the number one way that we get to move faster. Our relationship with experts is supremely helpful. My business partner, Maddie, has one of the strongest corporate venture capital Rolodexes of anybody I've ever met. She spent nearly a decade as a CVC investor, and she knows all the right people to ask the right questions and to get intros to the right downstream investors from corporates who may be able to help us out. And tapping into relationships with experts in other parts of our lives. I mean, we give other people an opportunity to be a value add by reaching out to them and asking them questions about their area of expertise and what they're seeing in their industry. And folks love being able to help, and they love to be able to demonstrate even in their own line of work that they are taking that next step and they're bringing value inside an organization by saying, hey, my friend who's an investor just told me about somebody who's building this, and kind of bringing those insights from pre-seed venture capital into normal later stage, more mature enterprises. And having a network of industry experts that you can tap for insights is crucial. And when I say industry experts, these are not PhDs. These are not people who are just in theory. A quick example is when we were doing diligence on Praxis Pro, one of our portfolio companies, which is in the pharma sales enablement space. I called up a friend of mine who runs a med tech distribution team, and I asked him, I was like, hey, does this sound helpful to you? And we were off to the races there. So tapping those different experts from different parts of your life, supremely helpful when it comes to speeding up and speed running the diligence process without shortchanging our LPs on our ability to get to strong conviction on a portfolio company and an investment.
Yeah, it's equal art and science, and because it's art because we don't deal with a full complete data set like you would in private equity or even public markets for that matter. You have to go off a lot of this art, this gut feel. And so then my question is when data is incomplete or ambiguous, what decision rules keep you from overthinking or even stalling?
Yeah, we know that at this stage, we are going to be dealing with incomplete information. So we go into it trying to fill as many gaps as possible. Our proof point is, can we make a story of what they're doing and figure out how that product fills in the gaps? And we can't really recreate that story if we're having to make a gigantic intellectual leaps for how this business is going to become venture scale or how this founding team is going to adapt in the future. If we're making those huge leaps and those leaps are bearing a lot of the weight, it's likely not going to be the right deal for us. So if it's logical and linear, and that doesn't mean that it's predictable or unexciting, it's just understanding how is this team going to bridge those gaps? Do they have the superpowers to make that virtually impossible looking leap look like a walk in the park? That's how we can get to conviction really fast. If we're doing a lot of mental gymnastics to get there, rather than wasting a lot of time, that's how we're going to get to a no very quickly. It all has to do with, can we build a belief system around this team? And it can be challenging without all the information, but these are the rules of the game, and we have to play with the information that we have.
So for people listening, what would you say that means to them?
Yeah, I think you have to listen to founders, right? Looking for plot gaps in the founders, the way that they explain their relationship to the business, their understanding of the problem, the product, the market. If there's too many gaps and you consistently find yourself having to go back and trying to piece things in like an incomplete puzzle, like I said, the premise of the question, we're all dealing with incomplete information. We're putting together a puzzle where half the pieces are missing anyway. If you're dealing with even less puzzle pieces than everybody else, that's probably a good sign to move on. Don't make it harder on yourself than you actually have to.
Yeah. So in the early stages, say like seed or pre-seed, which deal terms actually matter and which ones do you think are just noise?
So we only invest at the pre-seed stage. A lot of it is on safe notes, and the caps matter. But ultimately with the safe note, it is disadvantaged as a security or a promise for a security in the future. So, I think at the pre-seed stage, there's just not a lot of valuation, or there's not a lot of deal structuring mechanics and back and forth, at least in the deals that we're doing, at our size and check size. We are very valuation sensitive. We would much prefer to do convertible notes. That can get complicated though with founders who are participating in a large founder ecosystem. They've all been brought up on the the YC safe note, and they don't understand why on earth you would ever want to do a convertible security. It's something about interest. That's complicated. Just give me the safe note, wire a few million. Like, that's a hard conversation to have sometimes. But we ultimately, our responsibility is to provide outsized returns for our investors, and we're not going to be able to do that if we have no ability to recoup capital. And we do want to hold founders accountable and hold them to a certain standard. And that's a direction that I think we're starting to see a bubbling of that below the surface here in New York. And quite frankly, I think I think there's many investors who are excited to get to have the deal terms swing back, not away from founder friendly, but to more founder and investor effect.
Brilliant. Hey, if you're finding value out of this discussion, could you do me a huge favor? Could you just take a second and hit that like or subscribe button? It costs you nothing, but it tells the algorithm that this is valuable information, and it helps us to get it to more people. Thank you. You're incredible. Now let's get back to the show. So, well, let's fast forward then. So you find a founder, they've got the grit, you feel good about it, your art and your science of selecting the right deal tends to take off. So now you cut a check, and now we're off and running. So now we're married to this thing. So at that point, where do you focus your time to create the most leverage to help those founders that you've placed with?
So, we'll help founders with the things that they need. We help them raise their next round. We want to focus, it's a small team. It's Maddie and I. We're a small fund. And we want to, instead of trying to do 1,000 different things, not super well, we're going to do one thing really, really, really well. And that's to help them raise their next round. It comes from, Maddie and I, we both have strong networks. I'm a former investment banker. She was a former CVC investor. We know the right folks in the right places. Maddie can, help founders get the right intros. And I help founders understand that when they're going and talking to these next investors, if you're preparing for the partner, you're going to be sorely disappointed when you get the first year associate straight out of business. So the hardest sell for the founder is, how are you going to make that associate who has talked to everybody else, just like you, how are you going to turn them into your champion, who's going to turn around to the person who hired them, who they are terrified of, and feel super fortunate to have a job, and be like, hey, this is the one that I'm going to hang my hat on. I want to hitch myself to this deal and become your champion. And I lean on my background, running Wall Street after community college, getting kids who would normally get laughed out of a resume stack into first round interviews and ultimately into full-time jobs. So we focus on helping founders raise that next round, and we'll plug in wherever else we're able to help. But hot intros to folks that we know, talking up our companies, getting some excitement about them.
Brilliant. So that's all like founder, selecting the right deal and getting the information, looking for plot gaps, but you also have LPs who invest in you. And so which proof points or say assets most increase your LP's confidence when you raise capital for the fund?
We've been consistently looking for patterns in our LPs, and we've been tapping into these networks of professionals that we know. One of the things that has really jumped out is, like a fractional CFO and other fractional professionals who want to, wear the badge of a fund that is, out there, in the arena day to day, hanging out with founders and meeting them where they are, and using that as a way to signal, like, everybody's out here trying to get some capital from you. There's a lot of service providers. There's a lot of, it's like, professional athletes. They publish your salary in the newspaper. They publish your round on TechCrunch. Everybody wants to get a piece of that pie. How do you differentiate yourself in a world of, limitless AI outreach? Hit yourself to a VC fund that is always close to founders, and use that as a way to enter the ecosystem as a friend, not a foe. But we're consistently looking for those patterns in LPs, and really comes down to relationship building, right? That's the name of the game.
That is the name of the game. We always say, I like to say, especially for those listening to the show, reputation, relationship, and results are the three most valuable assets in your possession. And what those do is when you optimize it, and if you think of it like I do, an asset is something that puts money in your pocket. So if your reputation can do that, your relationships can do that, and definitely results can do that. But what all that comes to, the common pinch point of those three, is trust. It builds trust with people who place with you. And like I like to say, trust, it's more important to go for trust and transaction. If you go for the transaction before the trust, you'll probably get neither. But if you're if you're good and those people are good at raising capital, now you're at a place to say, well, first I got to build the trust. The LPs or investors need to trust me. And when they do, then that trust converts into a transaction, right? So high finance is a lot to do with trust over transactions. I love it, man. Anything else you can add to that?
No, I mean, you hit the nail on the head. And, it's funny. We went through this entire, you're refining your pitch, you're refining your pitch, you're refining your pitch. And the first LP that wrote a check, Maddie was going through her like other inbox on LinkedIn, and it was an alum of her university who's a professional athlete. He's like, you guys are, I love you, following you guys on LinkedIn. I was like, can I be in your fund? I'm like, wait, all of that pitch work? And of course, pitch work is important, but like that was the first check that we got, was like, check your other inbox. Like, so yes, it's about reputation. It's about trust. And, everybody's got a plan until they go out and start fundraising, and checks come from all of the places that you never expect and none of the places that you were really hoping.
Yeah, for sure. It's the Wild West for sure. So, my question then is, if an emerging fund manager wanted to replicate your approach, what parts of your system must be in place before they even think about raising capital?
Yeah, you have to be able to pitch, right? And you have to know what you're selling. You can practice the same thing over and over and over again, but you have to know what you're selling. And, ourselves at Daring Ventures, we went through multiple iterations. The thesis has never changed, but how are we presenting an investable product? This is a sales business. This is an investment management business and trust and relationship business. It is not a manifesto business. It is not a writing long-winded, missives business. This is we're focused on returns and taking that inefficiency that we were seeing between capital allocation and founders who we think have an outside ability to perform. It took a few refinements. It was like kind of tumbling and polishing a rock to get it to that place. That was a learning process, and every manager is going to have to go through that as they're practicing. And truly, I don't believe it matters whether you're a first-time fund manager or you're spinning out of a large fund, because you're going to have to play up to your level of competition. For us, it's high net worth individuals and family offices, and for somebody else, it's going to be CalPERS, right? And you're going to play up to your level of competition. And I think the other thing that is really important to remember is this is not just sitting in an investing seat. We are a startup too, right? We have operational responsibilities. There are things like the tech stack. There are things that like, finding an office and, making sure that we have cybersecurity and business continuity plans. Everything, in my life that was somewhere between probably not my job and definitely not my job is all now 100% my job. I have tech support. Maddie is HR. We wear different CFO hats, marketing hats, everything hats. Sweeping the floor hats, like we do everything. So, having that, remembering it's not all going to be deal work. You have to be in that place too. And it is the most fun and the most exhilarating thing of all time, working on your own project. And all of those not my job things are honestly the most fun part of the job.
Yeah, that's right, man. So before we wrap things up, final thoughts, any way that people can reach out to you, ways to connect, learn more about what you're up to?
Yeah, we are very active on LinkedIn. My full name, Joseph Alalou, and you can read our Substack. It's at writing.daringventures.vc. And we're always looking forward to engaging in great conversations with people who want to challenge us, people who want to collaborate with us, and people who ultimately want to work with us in one way or another. We're always just so stoked to hang out and chat with other people who are out there in the VC community.
Awesome, man. Well, this has been good to have you. And just to summarize everything that Joseph and I spoke about, make sure that you get good at pitching. Understanding how to market yourself and how to close deals is critical when building a fund, as well as listening to other people pitch you. The other thing is emphasize trust building. Remember, trust comes before the transaction. Too often, people who fail at raising capital or doing good deals, they just jump right to the transaction, and it makes it bumpy if it even happens. And finally, when incomplete information in your initial due diligence is there, just try looking for plot gaps to expose what might be missing. You do these things and you too will be well on your way in your pursuit of making billions.